guys, Brian Stevens here with the National Real Estate Post. I have the one and only Barry Habib today. And what I want to talk about is a little outside of our purview of what we've done in the past. And here's the reason why. Because Barry, when I'm looking at articles right now, trying to find out what's going on with interest rates, it is more difficult to get a handle on the direction of this market right now than I think it's ever been, trying to look at this stuff for the past 18 years. In one breath, you're seeing that rates are going to go up, rates are going to go down. COVID is certainly, a wild card that we're dealing with. They're talking about new variants in Europe. Is that going to affect rates? Of course, we have this whole, mess over with Ukraine right now. Is that going to affect what we're doing right now? Inflation seems to be out of control from my perspective. I'm dying to hear what you think about it. So how do we make heads or tails of this market, Barry?
Boy, it's a very good question. So what we had said was towards the end of last year, we had said rates have to go up because inflation looked to us like it was going to go up. It wasn't, that difficult of a call, I don't think, because when you look at the way inflation's measured, you look at the most recent 12 months. And what we saw on the horizon was incrementally higher inflation months figures to come. And then the months that were going to drop off of the 12-month window were all extraordinarily low. So when you looked at, June, July, August, September, those inflation numbers were near zero each month, and you were replacing them with 4, 5, 6, 10. So we saw that moving up, which is why we're talking about rates going a lot higher. Our forecast for the year said stock market going to be in trouble, more than 10% drop. Well, check that off. We also thought that the real estate market would do well. Check that off. We also felt that the interest rate environment would have interest rates go up above 3 3/4 is what we said. So it's higher than that, obviously, but we made the call at 3%. So we're still looking at a pretty big move up. But we also said that we saw rates coming down by the end of the year, right? So who knows, are we going to be right on that, or are we not going to be right on that? And that's the big one for everybody to look at. So a couple of things that you said there. What is driving this? Well, the biggest driver of interest rates, as I said, is inflation, because inflation erodes the buying power of the fixed payment you receive. If you're lending money, you're going to get a check for the same amount every month. The higher inflation goes, the less you can buy with that same fixed payment, because you can't increase your payment every month, right, unless it's an adjustable. So on fixed rates, you have to see those rates go up to compensate lenders for the higher rate of inflation. Now, the Fed plays a big role in this. And under normal circumstances, in normal time, it's a little easier. Even though it's counterintuitive, when the Fed hikes rates, if they're successful in bringing inflation down, well, then mortgage rates go down, because mortgage rates are driven by inflation. So longer term rates go down when the Fed hikes rates. Normal circumstance, even though the media doesn't understand it, people in our industry don't understand it, but if you look historically, you'll see the same thing happened with when Paul Volcker came in after Arthur Burns. He took our Fed funds rate from 11 to 20. Today, the Fed funds rate is 1/4% to 1/2%. Back then it was 11. He raised it to 20 in 2 years, so 9% in 2 years. At the same time, mortgage rates went from 18, think about that, to 12. Wow. Alan Greenspan took our Fed funds rate from 4 3/4 to 6.5 in 2 years, and mortgage rates dropped 3% from 8.5 to 5.5. And remember, in all of these cases, housing went great, interest rates went down, big refi boobs. So Fed's hiking, mortgage rates are coming down. Most people don't think of it that way. So why is this time a little bit different? Is because the Fed has this balance sheet. And as you know, and you and I have talked about it, you've mentioned it, the Fed's balance sheet, it's now $9 trillion, with a little less than half of that being mortgages. And as you know, Brian, when you have people pay off their mortgage, refi their mortgage, sell their home, or just the principal payments that they make, the Fed would normally collect that money. And just like any other time, when you have a bunch of loans on your books, as those loans get paid down, your holdings diminish, right?
Right.
The Fed, the dirty little secret here is that the Fed is taking that difference. They're keeping their balance sheet at this level. So any money that comes in, they're going back and they're buying more. And that amounts to $70 billion a month in mortgage bonds that they're buying. So just think about where mortgage rates would be if they weren't doing this, right? That's the fly in the ointment. Because if the Fed hikes rates, the bond market would like that. But if the Fed, and this is why rates have been jumping up so much, because the Fed has been alluding to aggressively allowing their balance sheet to run off. That could be very significant, because if if the Fed said, hey, we're going cold turkey, we're going to have full runoff, that's $70 billion less of mortgage bonds that people would be seeing purchased. And the market's just getting ahead of that right now and saying, hey, wait a minute, the Fed, Loretta Meester says, she's one of the Fed members. She says we should actually sell mortgage bonds. So forget about letting the $70 billion a month run off. Let's sell on top of that and drop the balance sheet by like 100 billion or more, that would be very disruptive. Could you imagine if you had a buyer out there buying 70 billion that turned into a seller of 30 billion? Now you got $100 billion a month less buying of mortgages. The question is who's going to buy them? They'll be bought, but you have to entice them to buy. How do you entice them? Higher interest rate entices them to buy, right? So all of these factors that can be variables that we don't know yet when the market doesn't know what the outcome is going to be, they stay on the sidelines. So you don't have the outside buyers saying, I'm going to buy with both fists because I got the Fed there to back me up. What if the Fed doesn't? Now, Brian, you also know this because I know you've kind of reported. We know that the Fed tends to talk tough, but when push comes to shove, they chicken out. They put themselves in this tough talk position. But then, if the stock market does poorly, if the economy looks like it's going to go into recession, which, by the way, I called it correctly the last recession. We are calling it again. We've been calling it since last August. We've been saying that this looks like a recession to us at the end of 22 and 20. I was with you talking about it, as you know, with Frank talking about it many times. So we are sticking to that. We feel really confident. There's a lot of reasons to believe there's a recession. Oil spikes usually lead to recession. Check, we got that. Inversion in the yield curve. The yield curve has gone from 1.6%. That's the difference between the yield spread, I should say. The difference between the yield on the 10-year Treasury and the 2-year. Usually the 10-year Treasury is above that. But from time to time, as the economy slows, inflation slows, the 10-year drops, and the Fed pushes rates up. The 2-year goes up because that's levitated by the Fed. When they go inverted, you get a recession. Very, very reliable. Well, a year ago, the 10-year was 1.6% above the 2-year. If you go back 6 months ago, it was 1.3%. The beginning of the year, 0.9%. The beginning of February, 0.6%. Now it's 20 basis points. I think it was 18 basis points this morning. I just checked it before we went on. It was 20 basis points. It's a moving target, obviously. This is going to go inverted. The Fed hikes 50 basis points. That 2 years got to go up. We're going to get an inverted yield curve. They might do that in May. That tells us there's a recession coming. Another one is the rate of unemployment. Unlike what most people think, and I remember we talked about this with you guys before the last recession, we showed the actual chart and we said, hey, when you take a look at unemployment, it's not when unemployment is high. It's when it's at its lowest level. Everybody's happy. Everybody's got jobs. But then as business is slow, they start to let people go. So it's at its lowest level and starts to tick up. So it's from the lowest point and starts to tick higher that those people that now become unemployed newly, they change their spending habits, less restaurants, less clothes shopping, less luxuries, and the stores that they would normally frequent see a slowdown. They let people go, and that cycle perpetuates itself and leads us quickly into a recession. That turning point leads to recession, usually within 6 months. Now, I don't know if we're at the lowest point in unemployment, but it's come down a lot, and we're certainly nearer the bottom than the top. Watch for that turning point in the unemployment rate. That would cement a recession happening very soon, within 6 months. I think we hit that turning point sometime later this year and leads to recession either end of this year or sometime in 23. So what does this all mean? During recessions, interest rates come down a lot. So that's when I think rates come down, and the housing market does well. It's done well in the last 9 recessions, with one exception, 2009, but that was because the housing bubble led us into the recession. It wasn't the other way around. And
right.
In each of the recessions, home values gone up after the recession.
Now, what type of a wild card is this whole Ukraine thing, or another wave of COVID coming around? Is that something that would put pressure on rates to go up or go down, or do you really see any type of effect at all?
Well, COVID, God forbid, this BA and variant right now is said to be much more contagious.
Yeah.
However, not as virulent, even less virulent than Omicron, which to me was, for most of us was not much worse than a cold, or maybe maybe even lighter than getting the flu. Heck, I hope nobody ever gets the flu. Is bad, man. That thing sucks. A lot of people say they have the flu, but it's really a bad cold. If you have the flu, trust me, you got the flu. That knocks you out. Okay.
Yep.
So I don't know that that's an issue. Plus, you have to consider this: much less people vaccinated in the areas that it's prevalent right now. And China, their vaccines do not work as well as the Pfizer or Moderna. They're less effective than even the Johnson & Johnson, right? So you have to, you're not comparing exactly apples with apples. Of course, we got to be aware of it, but for the wrong reasons, it would help interest rates go down, because that would slow things down. That would be a concern. But we don't want that. We don't want interest rates to go down because we have a problem with a COVID thing, right? But if that were to happen, you're right. It does push interest rates lower. But with regards to what we see, Russia and Ukraine, this is another driver. This was the black swan. A black swan event is an event that you do not see coming, and all of a sudden it comes out of nowhere. You have a bunch of white swans that are giving birth to white swans. All of a sudden a black swan appears. Where did that come from, right? So that's where the name of it comes from, of a Russia-Ukraine situation, which really did come kind of out of nowhere, similar to like the first COVID did, right? These events, under normal circumstances, would push interest rates lower because of the uncertainty. But this now, remember we started with inflation is the enemy of interest rates. This is an inflationary event because we've seen the oil spike, right? Russia is one of the world's biggest oil producers. The United States, unfortunately, appears to have, I'm not going to get politically, but it's restrictive now in its oil production. So we've become more dependent. And unleashing 30 million barrels of strategic oil reserve doesn't mean anything because
it doesn't.
We use 18 million barrels a day. And, how do we, even if you say, okay, but we're only losing 2.5 million barrels a day from Russia imports. Well, okay, so what does the strategic oil reserve thing do? It buys you 2 weeks? It's not great headline. It doesn't do anything. So, if we're not going to increase oil production, then naturally what you're seeing happen is going to happen. And that's oil prices moving up. It was in the mid 120s. It actually touched 130. Now it's, West Texas Intermediate, WTI, which is right now close to Brent. They used to be big differences, but now they're pretty close to each other. It's trading a little bit above 110 or around, it's moving target, but there's 42 gallons of gasoline in a barrel of oil. So you can see what you're paying at the pump, and the rest is taxes and profits and transportation of it. So it's going to impact you. It's definitely going to impact you when you see the price of a barrel of oil going up. And oil is in everything. It's in transportation of goods, and it costs to keep things. I don't have to tell you guys. You know what you're paying all of a sudden at the gas. A lot of you can't even fill up your tank because if you go to where you pump your own gas, you have a limit. It'll only take $100 or 75.
That's right.
Like, I need 120 to fill up my tank. You might say, right? So it's a tough situation. And for those that are on margin that can't really afford this additional tax, it slows things down. And, that's inflationary. And then you've got food. Ukraine is the food basket of Europe. It is the number one producer in things like barley and wheat for Europe. It is number one in the world in sunflower oil. And you and I talked about this in the past. Neon gas, number one producer. 70% of the world's neon gas comes from Ukraine. So why is it a big deal? Like it's very 1970s to think of your neon signs, right? But it is what's important and necessary in semiconductor production.
Great.
So, you need semiconductors for everything, right? So this is a situation that the world's so interconnected, and there are things that we don't think about that happen. That's why. Listen, everybody listening here, the difference, in my opinion, of thriving in these markets is being a chess player and not a chess piece. A chess piece, you're going to get moved around. But if you're a chess player, you've got to think 2 or 3 steps down the road. So let me try and wrap a ribbon around this, okay?
Sure.
It looks like for the short time here, we're going to see rates move up. I think if you were to extend your time horizon to a year or so, and longer than that, you'll probably see rates come back down as inflation slows. There's a lot of debt we still have in the economy that puts downward pressure on rates. And there's also a belief that we probably see a recession, which puts downward pressure on rates. So I would be trying to explain to my customers that don't pay points, don't pay upfront MI, and instead of searching for the lowest rate, think of it in terms of this loan is going to not be around for a long time. It's probably going to be around for less than 3 years. Pretty good bet. So if I can pay a higher rate, not a lower rate, and have less cost, remember the break-even period is usually about 5 years for the costs that you save by exchanging it for a higher rate. That seems like a great strategy. That's the exact same strategy I came on your show and said so many times at the end of 2018 through 2019, and that was a winning strategy, certainly. I see a similar setup.
Well, this is a great time to dust off the 3, 5, and 7 year arms right now. Look at those. That might be a pretty good. One last question for you.
I like the 5-year arm. I like the 5-year arm a lot. It saves you money, and it also puts you in a position to give yourself some cushion in case it takes a little longer. And I also want to say, I think the housing market's great. And I didn't mean to step on your question. I just want to mention I like the 5-year. But now some of you might be saying, well, I don't necessarily have a 5-year. If you don't have a competitive 5-year, go with a no closing or low closing cost 30-year. In essence, over time, will give you the same effect.
Gotcha. Now, just in one final question. Again, I know we're going a little bit long here today, but there's a lot of talk about the Fed coming out very aggressively, as you said earlier, talking about rate hikes for their next 6 meetings over the course of the next couple of years. This had a lot of people in the industry kind of panicking. What does that really mean? What I think I heard you say earlier is like, don't really trip on that. It's the balance sheet that we need to really kind of keep our eye on. The Fed's moving rates around aren't going to have a significant impact on rates by and large.
No, they'll be good. What you should do is pray for rate hikes and pray that it slows the economy and inflation and that they do not aggressively move their balance sheet. I know people just don't understand this. You just need to open up history and see what happened historically. Once again, Arthur Burns didn't do anything about it. Volcker took the Fed funds rate from 9 to 20, okay? And I'm sorry, from 11 to 20, raised it by 9%, from 11 to 20, and mortgage rates dropped 6%. Greenspan took it from a Fed funds rate of 4 3/4 to 6.5 in a year, and mortgage rates went from 8.5 to 5.5. If the Fed raises it, now, just you should also know that it wasn't too long ago in 2015, December of 2015, the Fed started a rate hike cycle and mortgage rates went down. But in 2017, when they started the runoff of the balance sheet, rates went up. The second they stopped the runoff, rates went way down. So all of these things are interwoven and tied together. So look, just quick, when we had Arthur Burns, he saw inflation go up, that meant mortgage rates went up. Then you got Paul Volcker comes in, takes the Fed funds rate. As a result, inflation drops and mortgage rates drop. Greenspan, like I mentioned to you earlier, raises the Fed funds rate sees inflation go up and mortgage rates go up as a result. He raises the Fed funds rate. Inflation as a result comes down, the economy slows, and mortgage rates go down. And now, here's our man here. We should see a drop. We should see a decline. Now, every single time in our nation's history, when the Fed has tried to slow inflation by raising rates, we get a recession. And these obviously were no exceptions. I don't think this is going to be an exception either. And the stock market does not perform well historically. Whether that happens again, I don't know. But here's the case study. In December 20, this is the 10-year, using it as a proxy for long-term rates like mortgages. When the mortgage rates were actually going up because of inflation, the Fed hikes, and look what happened to mortgage rates. They didn't hike again, so inflation crept back in, mortgage rates went up until the exact day that the Fed hiked, and then mortgage rates went down. Until the exact day they started the runoff of the balance sheet, and look what happened. This is why I'm so concerned about the Fed getting too aggressive in the runoff of their balance sheet. And when they slowed the pace of the runoff, we see rates dropping. When they stop the runoff, we see rates dropping. So this was the COVID shutdown, and here's our move back up. So these are all very important things for us to watch out for. Now, if you take a look at the inversion of the yield curve that we talked about this earlier, these periods are recessions. This is when the 2-year gets higher than the 10-year, the yield curve goes inverted. You see red, inversion, recession, again. Here you see like a little one. Yeah. You just see it, right? It's just like clockwork. Here's the little one here again. And now let's look at where we are now. This is the last 12 months. It was 1.6%. As I said, you could see the decline. I think today it's 20 basis points. So it's dropped a little bit further than this because it's a moving target again. And then unemployment. Remember I showed you look at this, go back to the 1940s. Every time unemployment hits the bottom and starts to tick up, recession. Again, every single time. Here's where we called the last recession correctly, right here, where we saw that tick up. And look at where we are here. Now, we could go lower, okay? So I'm not saying we don't go lower, but are we nearer the top area or are we near the bottom area? I think it's, every time we seem to get around this range here, guys, this is a really good time to forecast a recession, right? So now what happens during recession? Well, rates go down. Take a look. Every time interest rates go down. Doesn't matter if they start off low, they go lower. Notice each of these, you might say, well, we're starting so low. We're starting so low relative to the past. Here you can say, how far are they going to go down from 3 3/4? Well, they went to 2 3/4. Hey, we're in the, above 4% now. Do we have room to get back down to 3? I think so during the recession. Now, real estate, you go back to the 50s and the 60s. Real estate did fine in the 70s, did fine in the 80s, went up in the 90s, went up in the 2000s. The most recent recession went way up. And after every one they have, this is the anomaly. But that's because we peaked and then values of homes started to come down and led us into the recession. It wasn't the recession started and led us into bad real estate market.
Right.
After each recession, look what happened after each recession to real estate values. Up every single time. This was the housing bubble. This was, 100 LTV, 580 FICO, no income, no asset, no job, okay,
right.
That was the poison well.
The guy running the fryer at Denny's is not an executive chef making $200,000 a year.
There you go. There you go. God bless that guy. He's, he's working hard, but
absolutely.
Yeah. But those loans weren't the best to be doing it, at that time. So,
right.
Again, I feel good about the real estate market. I feel very good about the health of it going forward. We could do another talk on that sometime, and as to
absolutely.
why. But I feel really strongly about that. I feel strongly we're going to see a recession. I think that rates should come down. I'm concerned about where we are right now because the Russia-Ukraine thing. I mean, look, first off, the humanity of it all, and look, could this escalate and get really troublesome? Let's pray to God, no, but you've got a bad situation there. Let's just hope that calms down. Thank God that calms down. Pray to God. If we see the Fed lower inflation, we should be fine. The balance sheet worries me. One tiny silver lining on the balance sheet, because volume levels have dropped. That means there's less fresh mortgage-backed securities on the market. So the Fed doesn't have to buy as much as they did to have a similar effect, is what I'm saying. So you have less supply coming on the market, so the Fed doesn't have to eat as much. So okay, drop your balance sheet if you have to, but can you please do it carefully? Can you please do it incrementally? Don't get too aggressive. Don't be a mad scientist. Look, bro, when I learned how to fly a plane, my instructor drilled it into my head so many times. Incremental moves, incremental adjustment. You can't whip the plane around. You get in trouble. Easy, because you steer with your feet on your rudder and your ailerons. It's smooth, easy. That's what it is. I like to drive on the track. They teach you fast is not fast. Smooth is fast. That's, these are lessons you get from your instructors. If the Fed were to take these lessons, I think that would go a long way.
Well, let's hope. Hey, Barry, thanks for jumping out and doing this with me today. Totally love having you on here. And yeah, let's get back next week maybe and talk about the housing market.
Yeah, we'll make some time for sure to do that, because I do believe the housing market's really good, bro.
Awesome. Thank you so much, Barry.
Thanks, everyone.
Talk to you. Bye-bye.